The Reserve Bank has sprung a hawkish surprise in its June policy. Yes, the interest rate and the stance has been left unchanged as expected by the CNBC-TV18 poll and the Citizens Monetary Policy Committee. But the nuances are hawkish. The CPI forecast, inflation forecast for FY24, it was expected to be cut to below 5%, maybe 4.8 or 4.9 from the previous 5.2, has been cut only 10 basis points to 5.1. Also, the governor repeatedly insisted that the MPC's mandate was not to get CPI to the tolerance band of 4 to 6%, but to align it to the target of 4%. Let's first hear out the governor.
Given the uncertainties, we need to maintain Arjuna's eye on the evolving inflation scenario. Let me re-emphasize that headline inflation still remains above the target, and being within the tolerance band is not enough. Our goal is to achieve the target of 4% going forward.
Post-policy, the 10-year bond yield rose a bit, ended over 7% from the overnight close of 6.98, went to 7.02. But in the swap market, the yields moved much more as hopes of an early cut clearly vanished. Now it's getting pushed on to April, at least in the swap market. To understand more about what the policy means and for their thoughts on the state of the economy, I have with me perhaps the best brains trust of the market, Dinesh, Khara, Chairman of State Bank of India, B. Prasanna, Head of Global Markets Group at ICICI Bank, Mridul Saggar, former member of the Monetary Policy Committee and former Executive Director at Reserve Bank, Samiran Chakraborty, Chief Economist for India at Citi. Gentlemen, thank you very much for joining me. Mr. Khara, would you agree this is a slightly hawkish surprise?
Well, I think the way I look at it is, yes, of course, stance is something, and also the expectation in terms of inflation. What you mentioned that we were expecting much lower expectation of inflation. Well, if you evaluate on those terms, yes, perhaps yes. But
okay.
The fact of the matter is that there are various uncertainties which are still there in the system. That is why perhaps this kind of a announcement has come from RBI.
Okay.
That's why.
Okay. All right. Well, Samiran, the expectation, at least in the stock market, was a bit cheerful that growth could be, forecast a little higher and inflation would be forecast a little lower. That combo would have been great for definitely the stock markets, maybe a little less so for the bond markets. What's your sense? The RBI is way more cautious about inflation and also about growth, you think?
I think the growth estimates are quite realistic. The inflation forecast, in our view, RBI is slightly more conservative at this time because there is this uncertainty around weather-related shocks over the next couple of months. So since RBI has waited for so long to get inflation down to its medium-term target, at this juncture, they would probably want to see through these weather-related shocks. And also the recent significant decline in momentum in core inflation, we don't think RBI has factored that in for a longer period. They probably think that momentum would come back in latter part of the year. That's why probably the governor has very clearly mentioned that there are still price pressures in second half. Whatever adjustments to the forecast that they have made is only for the first half, which is more of a mark-to-market nature. And the last point is that I don't think they are building in any sort of a reduction in fuel prices in their current forecast, but we know that that's one possibility that could emerge in the latter part, and to that extent, there could be some downside surprises to inflation as well.
Okay. Since someone has already worn the MPC's, the official MPC's hat, you are our Citizens MPC member, but the official former MPC member is also with us. Mridul, what do you think is going behind this kind of an inflation forecast? Clearly way above what the street was expecting the RBI to do. They've just brought down the Q1 from 5.1 to 4.6 and distributed it over 4 quarters for the full year and brought it down by 10 basis points, not factoring in a momentum of lower inflation. What do you believe is the thinking? behind this?
I think it's a typical conservative central bank attitude. So as I have typically said, that there is a downside to the RBI's inflation numbers. Now, having said that, let me clarify one or two things. Firstly, they brought down the inflation forecast from 5.2% in April to 5.1%, but they also means that 10 to 12 basis point, which is not factored in on account of the MSP hikes, the target goes back to 5.2 for all practical purposes. Now, if it is on normal monsoon assumption, which is part of the statement, then there is a downside to it. But I think this year the weather disturbances through El Nino and probably late monsoons and climatic changes can cause a havoc. So there is a cushion in RBI forecast, and that's important to understand, that the cushion could come pretty handy. Only thing is, this under the normal monsoon assumption, this assumption may not hold.
Okay. No, my assumption, yeah, maybe it was a cushion given because of the weather, but chances are they just don't want to sound dovish. And maybe that's why a wanton overestimation of the inflation, or conservative estimate of the inflation. Prasanna, now the more material question for you and for Mr. Khara would be, when do they cut?
So I think, Latha, I was actually hoping that even though the expectations of a change in the stance was actually getting priced out in the last 1 or 2 weeks because of the higher liquidity balances, the El Nino risk, the fact that the Fed is going to hike later, probably in July, and also the other central banks also coming in and hiking. So most of the market really didn't expect the stance change to happen. But I think, like you rightly said, this level of maybe some more level of dovish pause was what would have been expected by the market. So to that extent, I think the question is very valid. So I think right now, like you also rightly pointed out, I don't think this RBI and this governor at this point of time want to signal to the market that rate hikes are just around the corner, because of all the 3 or 4 reasons that I spoke about just now. So it's quite possible that they want to keep the flexibility with them and not really give away all the cards to the Reserve Bank. So it's quite possible that if all the expectations do actually materialize in terms of the Fed actually peaking in July and inflation actually, coming down, it doesn't take much for the central bank to also, look at changing its stance and maybe, cut later. But having said all that, we were anyway of the view, our house view was for a rate cut only in February or maybe in April. I think what has happened today kind of strengthens that belief that we can't expect a rate cut from RBI this calendar year. Okay,
so the RBI went with ICICI's thinking, huh? So it seems. Mr. Khara, what does it mean to the bank actually? Bank stocks I thought actually would fly today, but for other reasons there was a subdued end to the Nifty Bank. But basically that puts you all in a sweet spot, isn't it? Liquidity is plentiful, so you all don't have to raise deposit rates, and you are all linked to external benchmarks, so lending rate is going to be high. You're going to enjoy higher margins for a couple of quarters more, you think?
That is what we expect in the normal situation. But at the same time, we are always very mindful in terms of when it comes to the lending rates, what is something which really works in the market. So the excess liquidity also lead to a situation where the competitive pressure for the quality lending also goes up. So that also has to be kept in mind. But nevertheless, I would say that, yes, if at all the real economy grows well, that is always an opportunity for lenders. And invariably, it leads to the better situation for the lenders in terms of their net interest incomes.
Okay. So actually, the governor gave the details of the return of the 2,000 rupee notes. Half of it has come back, 1.8 lakh crore, of which 80% is going to deposits. In that case, would you say that deposit rates don't look like rising for 2 quarters?
I was not expecting deposit rates to rise as it is, but yes, of course. But much of it has to be seen whether this money stays into the accounts, because when I look at my numbers at a system level, I think the deposit growths are somewhere around 10%, which is of course better than the 9% last year. Yeah. So I think there's some positive movements in terms of the deposit growth. And as far as the loan book at the system level is concerned, it is somewhere around 13-14% growth as compared to about 16%, 15-16% last year. So I think there's a bit of a recalibration in the deposit growth and also in the loan book growth. So that's how it looks like at the system level.
So even for lending rates, you don't see that much of a competition for loans. So you don't see the cost of capital rising for, say, a typical AAA company.
I don't think so, because for the well-rated corporates as it is, there's a huge competition among the lenders.
Okay. Well, I'll take a quick break, but then we have lots more questions on the state of the economy from the bankers and the economists who are with us. We are back in a jiffy. Welcome back to this special discussion on the Reserve Bank of India's monetary policy, which kept rates and stands unchanged but sprung a bit of a hawkish surprise. I have been speaking with Mr. Dinesh, Khara, B. Prasanna, Mridul Saggar and Samiran Chakraborty. Gentlemen, thank you for your patience. Samiran, now what is your sense about when liquidity might tighten? Does an expectation of a CRR cut now just goes out of the window for FY24?
I think at least for the lean season, it appears that there is going to be ample liquidity in the system. But what's interesting is that the RBI has quite consciously made a distinction between quantitative assessment of the liquidity surplus versus the assessment that the overnight call rates would have to stay close to the repo rate as a real indicator of how they're going to look at liquidity. What it means is that there could be a coexistence of surplus liquidity along with repo rates remaining close to weighted average call rate. And there's no need to take out liquidity from the system in a hurry. But our sense is that for the time being, the fine-tuning operations of BRRR and BRRR, they would probably get primacy rather than durable liquidity measures of the variety of either CRR or OMO, at least in the lean season.
Prasanna, you agree? You think that we're going to have flush liquidity with Reserve Bank just ensuring with this fine-tuning that call rate stays at 6.5%? Will that be the shape of things? And therefore no CRR cut or OMO purchases of bonds?
Yeah, so before around a month ago, we were expecting a CRR cut to happen maybe towards the end of Q2 or somewhere in the middle, because our view on liquidity was that it will be deteriorating. But then 2 or 3 things which changed it are the RBI dividend, the FPI inflows, as well as the INR 2000 program. So I do agree with Samiran that the first half doesn't definitely look like a possibility right now. In fact, I mean, it's quite possible that the lean season of CIC, or rather the time period when CIC actually gets sucked out a lot is during the October to December period, and where we will have the elections also around about the same time. So it's quite possible that it is that period when, liquidity flows out. But till that time, RBI is going to be, I mean, we will have a surplus liquidity in the system. RBI will be very proactive in taking out liquidity using VRRs to ensure that, the interbank call rate does not fall much below the repo rate, which is the operating rate.
Range of the 10-year for 2023 for the remaining 6 months? Prasanna?
No, that's quite difficult, Latha, but I would say that there is a marginal uptick in the range. As of now, it looks like 695 to 710 kind of a range. There has been a lot of buying which has been happening from investors whenever yields tick up a little. And also there was a lot of hope that, at some point of time, there was a lot of confidence that at some point of time during the year, there will be a rate cut. To some extent, that's got postponed a little. So that is the reason why I said that the range shifts a little bit to the right. But at the same time, realize that Q2 is a very heavy supply quarter. So we have to see whether investors' demand especially in the longer part of the curve, sustain at that point of time.
Yeah, we have to look at the insurance companies, right? In any case, at the moment, it does look like it's going to be a long, stable period. I mean, we're not talking much in terms of even yields going up. It's about maybe 5-10 basis points. The range seems a fairly steady period. Mridul, to what extent does RBI look at the global factors? They keep saying ours is domestically oriented, but you had a Bank of Canada hiking rates unexpectedly. You had Reserve Bank of Australia doing it. The global situation is still like everyone expecting a recession, which is perhaps getting postponed. So, how do you parse this global backdrop in? RBI has to parse it in, right?
So, Latha, obviously, I think that was not the communication of the governor, that he doesn't look at the external situation. What he was trying to say was that it is predominantly the domestic condition. So let us understand that India is a coupled economy. It's not decoupled economy. And if global financial conditions change and there's rub-off on the Indian financial conditions, that will get factored into the monetary policy for obvious reasons. And today, the World Economic Prospects, which the World Bank released, kept the global growth forecast at an alarming 2.1%. So the slowdown message is very much there. Incremental data suggests that the slowdown is taking place at a slower pace than was earlier anticipated. So
yes,
not panic. I think going lower down, maybe in the second half. So today's policy was unusually sounded like business as usual, Governor was like very, very positive in his macro sentiments, but then he's an epitome of calm even at the times of crisis. So that's not surprising. What is important is to understand that if things change in the second half, the policy will nimble-footedly respond to that. And I think there is a downside on the growth, and there is a little downside on the inflation also vis-a-vis the projections.
Okay. I mean, this is interesting. Samiran, do you think we are in for a bit of a Goldilocks for the next 1 year? This recession is more in the minds of economists. It's not really happening. Do you think we are in for at least the next 12 months looking good?
We hope so. We had 3 turbulent years.
No, not a hope. As an economist, your projection.
If I go by my projections, I think it's a relatively decent period where the India growth is going to be better than global growth. And most of the macro stability parameters, and we're discussing only inflation out here, but we also look at external sector parameters to be much better this year compared to the last couple of years. And fiscal also consolidating in a nice way without too much of populism. So if we put all of this together, then I would say that sounds almost like Goldilocks.
Okay. Well, that's good to hear. But Chairman, Khara, we have quite a few developmental things which I wanted to ask you, at least 2 of them. This prudential framework for resolution of stressed assets, especially on write-offs and compromise settlements. Is that good or bad? I mean, are they against technical write-offs, or is this just putting some rules in place?
I think it is positive because there would be different practices across different banks. So I think any kind of a guideline from the regulator would certainly be of a welcome measure. So I would rather say that it will probably even further ease out or maybe put in place a structure for resolution of such kind of assets also.
Okay, yeah. I mean, there at least when you speak to some of the public sector bankers in particular, there is a nagging worry that when you get into a compromise, who knows when the file gets opened. You think this actually emboldens and enables bankers?
Yes, certainly. So, in fact, we keep on doing the things, not that we wait for such kind of enablers. But yes, of course, it will further facilitate the environment.
Yeah, no, I agree that State Bank often is a class of its own in this, but clearly these doubts get removed if that is the intent. And the other thing I wanted to ask you, this first-class guarantee, which a lot of fintechs indulge in, that got a bit of a support with the RBI saying that guidelines will come. How do you think it will play? Does it embolden them and they grab some business from you?
No, I think the most important part is that it will have an impact on the capital charge. If at all first-class guarantee is there, the capital charge will get reduced. So I think that to that extent also it is positive.
Okay, and finally, sir, you are best placed to say whether it looks like Goldilocks. Do you think there is healthy demand or is the demand petering out? As you said, from 16%, it's coming down to 14%. What's your assessment of the economy?
I think in general, if at all I would comment that the trend is quite positive and the real economy looks to be in a good shape. And when the real economy is in good shape, the bankers are all celebrating. So that is how it is.
And there was a bit of a reluctance to give a date for the expected credit loss rules. You were happy about that?
Yeah, I think my expectation was whatever our RBI governor has indicated, we were expecting similar kind of a trend, direction from RBI. So it has come out. In fact, it has addressed some of the anxieties which are there in the mind of many.
Okay, fair enough. Yes, certainly. And even amongst investors. I agree with you, sir. Thank you very much, Mr. Khara. We are out of time, but I think we covered the policy comprehensively. Samiran, Chakraborty, Mridul Saggar, Prasanna and Mr. Khara, thank you very much for adding to our understanding of a monetary policy that was a slight twist in the tail. Thank you very much for watching this special show.